Hello, and welcome to the May 2024 edition of the U.S. Energy Insights. I am your host, Pamela Munger, and I'll be taking a look at the latest trends and market conditions within U.S. and global energy and sharing actionable insights powered by Vortexa's tracking analytics. After the success of the March edition, where our senior oil risk analyst, Armin Azizian, shared some insights on sanctioned flows and the opaque fleet, this month I've invited the well-known and respected principal analyst from Lloyd's List Intelligence, Michelle Bockmann, to share her world-class insights. But first, we will focus on global crude inventories, clean product demand indicators, China update, and Atlantic Basin gasoline. Global onshore crude stocks saw a marked uptick over the last week, adding 15 million barrels, nearly reaching 2023 volumes. Storage tank utilizations rose, and all crude in tanks and tankers witnessed a particularly sharp build nearing last year's levels after reaching a low point in February. Now let's take a look at our top 100 import indicators. This is based on arrivals into ports where at least 90% of overall flows are imports. This is expected to be a good indicator of underlying demand as trading storage hubs are excluded. We have pointed out repeatedly that import demand was generally trending lower since sometime in Q2 2023. However, this trend appears to have come to an end, with low points recorded for gasoline and diesel in November, for naphtha in January, and jet kero in February. Supplies, especially from the east of Suez market, have picked up tremendously over recent months, somewhat overwhelming import markets, as reflected in easing refinery margins and cracks. But much stronger arrivals in import ports do suggest that demand momentum may have really changed, and seasonality is increasingly tilted toward the summer travel season. Now let's turn our heads to China, who has recently issued higher clean product export quotas, and see what it means. China issued 14 million tons of clean fuel export quotas for the second batch, and this is compared to 9 million tons in the same batch for 2023. You can see in the light green bar that jet production has ramped up in Q1 2024. China's kerosene production jumped to 1.2 million barrels per day in Q1, up 35% year on year. Now, weak run rates still persist, and crude imports are below the 2023 average, especially among Shandong teapot refiners, as we see imports lower and stocks building. In addition, the 400,000 barrel per day Yulong refinery and petrochemical complex at Yantai planned to start trial in June, but now looks unlikely and will be likely to open in September. As we move closer to U.S. elections and driving season, we can see that U.S. Atlantic Coast gasoline demand is looking better than the margins are suggesting. Global gasoline margins have weakened recently, despite moving closer towards driving season. U.S. margins have started off the gasoline season below last year's levels by nearly $3 a barrel, and the transatlantic arb, on paper at least, has been slow to open, despite relatively low freight rates and low gasoline stocks in Pad 1. However, as we look closely at Pad 1's seaborne gasoline imports, we see a similar yet lagged pattern compared to last year. Having started this year 100,000 barrels per day lower than 2023, the sudden sharp rise in gasoline imports mimics last year's trend, despite entering March 2024 with inventories at the bottom of the 5-year range. Low stocks were partly due to the Atlantic Basin refinery outages, which witnessed a slow return, keeping average April run rates at around 83.3% versus 91.4% last year. March also brought historically low stocks in Pad 3 and lingering refinery turnarounds in the region, a major resupply point to Pad 1. At a time of softening US gasoline margins during April and May, European gasoline margins moved higher year on year to the tune of around $3 a barrel, incentivizing refineries to optimize gasoline production and blending operations amid poor petchem demand. We can see that loadings since January increasingly stay within Europe, in the blue bar, likely for these blending operations. Reformer margins have been higher on average year on year between January through May in both Northwest Europe and the US Gulf Coast, incentivizing refiners to run naphtha through the reformers to produce high-valued gasoline blending components, namely reformants. Now let's look at an update on the Trans Mountain pipeline. So the Trans Mountain expects to load around 30 to 40 Aframaxes a month from Westridge Terminal, which currently only loads 2 to 3 Afras a month. To demonstrate a more realistic scenario, we decided to look at potential monthly exports out of Vancouver based on Afras loading. And we believe the first two scenarios of 12 to 16 Afras are more likely in terms of seaborne exports. These Afras will then either travel directly to Asia and ballast back to Vancouver, which will mean higher freight cost, or travel to the US West Coast refiners, a more likely scenario. Another option is STS transfer to a VLCC, which is not possible off Vancouver due to rough seas. So the likely option will be to STS further south near Panama or California, where permission is required from Californian authorities for loading VLCCs. This will likely displace long-haul crude arrivals into the US West Coast, as well as some ANS barrels, which then might have to find buyers in Asia. We will only find clarity regarding the actual impact of the TMX startup once the first cargoes start loading in the second half of this month. And lastly, a quick update on CPP tankers leaving the Russian trade. We have seen evidence of more clean product tankers leaving the Russian trade in March and April, adding supply pressure to Atlantic Basin MRs and absorbing LR demand. Now, since it's an election year in the US and sanctions continue to be a hot topic, let's turn our attention to well-known and respected principal analyst from Lloyd's List Intelligence, Michelle Bockmann, to share her world-class insights on the dark fleet with a special focus on Venezuela, Iran, and Russia.
Thanks very much for having me, Pam. I'm going to take a whiz through looking at sanctioned oil flows using Vortexa data, and then I'm going to overlay on the top some Lloyd's List Intelligence data to really slice and dice the data and give us a really complete picture of where the sanctioned crude is going and how it's being shipped and on what vessels. So first of all, I thought I would start by looking at just how much sanctioned oil is being shipped. And I've taken March 2022 as the start date because that's just shortly after Russia invaded Ukraine. And since July 2023, we can see that oil flows from those three countries have averaged 6.78 million barrels per day. And that's 17% of all seaborne crude flows. So it's quite a substantial amount. Now, I've picked July 2023 because that's when price assessments showed that all the grades of crude from Russia surpassed that $60 a barrel price cap that was imposed by the G7 on Russian oil. And so technically, anything that's leaving Russia now, crude-wise, is assessed at least on paper as above the price cap. And so that's quite a lot of seaborne crude flows. Where is it going? Well, no surprise, most of it is going to China. And when we look at China's imports from those three countries, they've now averaged 27% of their imports when you look at the first 4 months of the year. And that compared to 18% in February 2022. That's a 45% increase, by the way. So back in February, imports from those three countries, 1.6 million barrels per day. And now it's at 2.4 million barrels per day. And again, a lot of this crude is deeply discounted, Hence, it's going to the world's largest importer and biggest user of crude, and it's finding a ready-made market. Technically, if this is sanctioned by Western regulators, primarily the US, the UK, and Europe, how is that happening? Well, Iran is defying these regulators, and it's taking all of its oil on about 220 tankers when I looked at Vortexa data from the last 12 months and how many ships were involved. And of those 220 tankers, there's 125 very large crude carriers, so the largest vessel type that carries 2 million barrels per day. And only a third of that is happening on sanctioned vessels. So the remaining 2/3 is happening on ships and what we call the dark or parallel fleet of tankers that are being used for this purpose. A lot of the tankers are sailing to China. China imports 75% of Iranian crude, and it's happening on a very complex ship-to-ship transfer network. So cargoes are often shipped on as many 4 different tankers before they arrive at their destination. It's often held in floating storage. And I think if you look at something that was loaded in March in Iran, and normally with the vessel its AIS is off, it doesn't arrive in China until maybe April or May, simply because it's a very inefficient and complex system. The ship-to-ship transfer spots are in international waters off Southeast Malaysia, anchorages off Lingai on the eastern seaboard. They're also happening at Sohar anchorage off Oman and at Corfracan in the United Arab Emirates. And so there's a list there of where we see those hotspots. As we said earlier, this is all part of the dark fleet. What is the dark fleet? I have to take you through the methodology. That's because if you can't measure it, you can't sort of see what it's doing. So aged 15 years or older, anonymously owned or has a corporate structure that's designed to prevent beneficial ownership discovery, solely deployed in sanctioned oil trades, and then engaged in one or more of the deceptive shipping practices outlined by the US State Department in guidance issued back in 2020. That can range from ship-to-ship transfers in international waters to avoid port state control scrutiny. It can be turning off the ship's vessel tracking transponder in order to hide the loading or the discharge of cargoes or a ship-to-ship transfer, or it can be those really complex layer upon layer of ownership and management chains that are designed to prevent people finding out who the owner is. Just some important facts to consider. Just because it's in dark fleet doesn't mean that it's breaching sanctions, especially in the context of the Russian oil price cap. That's a very sensitive area. That information about the price at which the oil is bought or sold is private and confidential. So we have to say that, we're sanctions agnostic on the list, which gets us to the key figures: 600 tankers, 83.7 million deadweight. 82% of dark fleet tankers have no known P&I coverage, and that's insurance, liability for environmental or oil spills or if there's a casualty. About 300 of those 600 are directly linked to Russian trading. That's supported by another 200 Greek-owned tankers. Again, that includes diesel and refined products, which of course is trading in May 2024 is trading below the $100 a barrel price cap. And then you also have, for example, the 220 dark fleet tankers that I've tracked in Iranian crude as well. The next slide looks at the parallel or dark fleet, how it uses regulatory arbitrage to avoid scrutiny and circumvent Western sanctions. It accounts for 14.5% of the current internationally trading fleet. And the data here from Lloyd's List Intelligence shows that VLCCs, of course, are very popular because the ultimate destination is China, which uses VLCCs at its ports. But Aframaxes and Suezmaxes are also favored because they're used most frequently in Venezuelan trades and Russian trades.
Now, can I stop you there for a
Yeah,
moment? You talk
sure.
about Venezuelan trade, and we saw that sanctions were not relieved by the U.S. Government. The sanctions were not lifted, rather from Venezuela. However, some of the waivers still apply.
Mm.
But we haven't seen an influx of Venezuela crude, or have we, coming to China? What are your thoughts on that?
Well, Venezuelan crude imports have just been diminishing year by year. I've just been watching Venezuela circle the drain, for want of a better word. And I think we're only looking at, 400, 500,000 barrels per day at the moment. Until the waiver was not renewed on April 18, a good majority of that was going back to the US. But I think at this moment in time, we're just seeing everyone repositioning and working things out. And also, Venezuela has a need for condensate and also to thin their heavy crude, for want of a better word. So there's a lot of moving parts in place, I think, to redirect oil flows.
Is there a tanker issue? Because you mentioned the need for these VLCCs, sometimes Suezmaxes, sometimes Aframaxes, in this parallel trade. Is it a lack of tankers? Is that the issue from in Venezuela?
Not what I'm seeing at the moment. A lot of the tankers that were involved in Venezuelan trade shifted to Russia in that 6-month period while there wasn't any direct US sanctions, and that was filled by a lot of legitimate and conventional trading. We're really in a transition period, I think. There have been a lot of oil companies standing back and just waiting to see what's happening. It's a work in progress, I think.
Thank you.
So we'll just come to the dark fleet when we look at it by flag state and ISM managers, and that's the ship managers responsible for the vessel. And when we break it down by flag, we find that 44% by deadweight are flagged in Panama. And even though Panama is the world's largest flag registry, it is disproportionately overrepresented here, whereas Liberia and Marshall Islands, which are the second and third largest, are disproportionately underrepresented. But what we've also seen is a host of private registries that run flags on behalf of smaller Caribbean African nations have dominated these trades. Antigua and Barbuda, Cameroon, Cook Islands, Gabon in particular in Russia, it's taken on a lot of Russian business. These flags have deliberately gone for that regulatory arbitrage. And when you look at the ISM manager of the dark fleet by country, you can see that almost 2/3 are based either in China, Hong Kong, the United Arab Emirates, or India. And of course, that reflects the destination for most of these sanctioned crude flows that we were talking about earlier, and the fact that the UAE has ended up as a central point for Russian crude trading. When we look at the dark fleet by registered owner and P&I insurance, so the registered owner is the single ship company that's formed for the vessel, usually in a jurisdiction with favorable tax measures. We can see that the Marshall Islands, which is run by a US incorporated company, the registry there, 37% by deadweight of registered ownership is there, which compares to the flagging. There's only about 9 tankers flagged in the Marshall Islands, but in terms of registered ownership incorporation, it's 37%. That's an overrepresentation, and that reflects the fact that seems to be the choice of incorporation for a lot of dark fleet vessels that are involved in Russian trading. When we look at the dark fleet by insurance, we can see 82% are outside the international group of P&I clubs. There are 12 clubs that form that group. They cover 80%, 87% of the world's fleet and provide insurance. And only 18% have some sort of coverage there. We know that Russia's Ingerstrack provides a lot of P&I coverage for Russian and Iranian flows, but it's unknown. But that's an enormous worry about the environmental and safety concerns about those vessels. Finally, I just thought I'd go through a little bit of the behind the scenes of how Iranian oil in particular is making its way to market. And this is from a website called Wiki Iran, which leaked a whole series of oil and shipping and oil trading documents. And it's just interesting how it happened. So I started by looking at the purchase of a tanker for this sort of trading and to go into the dark fleet. And one of the first things I found was an invoice to purchase a spare AIS transponder, which is obviously required because the tanker is going to be spoofing its location, which is to say it's in one area when really it's somewhere else, so it can load without being detected. And then I saw emails about how the crew of this vessel required a bonus because they had to paint over the ship's name on the hull and put on a fake one. So when it called at the Iranian anchorage, it had a fake name, but its real AIS number. And then it received documents that were from the Iraqi oil marketing company saying that the crude was in fact Iraqi condensate instead of Iranian condensate. And then that was taken by the crew to Malaysia, and they repainted the new name on. They then did a ship-to-ship transfer with a fake bill of lading off Malaysian waters. It went to a mother vessel. It was then transferred onto another tanker and sailed onto China. Just really interesting how those sort of things happen.
Absolutely. And, I never thought a lead indicator could be paint sales, but there you go.
Yeah.
Fascinating process. Thank you for sharing that with us. Now, in terms of the tanker behaviors, is there any specific tanker behavior that you've noticed and that can be telling us about how these sanctions are working, or if they are working or not working? Are these vessels, and sanctions can include, of course, no insurance if you're operating above the price cap. Also, the recent sanctions, which are sanctioning certain financial institutions, certain ship owners, and even certain ports. So collectively, what would you say about how sanctions are working or not working?
Well, I think the only real effective sanctions that we've seen was the designation by the US government, by OFAC, of the Hennessy Holdings fleet of 18 tankers. Since then, those tankers have more or less ceased to trade. A couple have gone to Iran and loaded a few cargoes. They're now sort of at anchorage, but most of them have just stopped trading. They're just sitting around. A couple of reflagged to Eswatini, which is what we call a fake or fraudulent registry, a pseudo registry. Some of the ship managers that were sanctioned by the UK, they have all reorganized and taken all their tankers into new organizations. And I actually have a naughty list of tankers that have done that, which I can show you now. You can see here in the red the companies that were sanctioned by Western regulators in the last 6 months. Fractal Shipping, Radiating World, they have all gone to new companies. Hennessy Holdings, you can see there, have managed to be stopped trading. But when you look at entities like Gatic Ship Management, and there's a whole list of names here, they are now those vessels are going through their third iteration of ISM management changes, all in an effort to confuse regulators and to sort of stay one step ahead.
Wow, that's really enlightening and interesting about this whole other world of tankers and names and lists. Thank you so much, Michelle, for being with us today and offering us your fascinating insights. We really appreciate it. Thank you. Well, that's it for the May edition of the U.S. Energy Insights. Thank you very much for watching, and I'll see you next time.